Hello friends, I am Monjima Kundu. Today we will discuss about the topic overview of financial instruments. Now we will see this topic in details. First of all, we will see the introduction part of this. Now let's start with the introduction. In the financial world, instruments like shares, bonds, and mutual funds provide our financial system with different investments adventures. When you go to deposit a check, buy shares of a company, or when your parents invest in mutual funds for future returns, have you ever wondered what these instruments are? It is nothing but they are actually a financial asset. Now, next come to the next part. Now we will see the main thing. What are actually financial instruments? So let's see this part in details. A financial instrument is a piece of paper that shows that a person who owns it or has a claim on something. Successful trading is selling something for more money than its purchasing price. In India, most families try to save their money for a rainy day or secure their future. The question is whether that they are getting returns on their invested money. So this is all about the financial instruments. Now next come to the next part. Now we will see why it is important to know about the financial instrument. So we are dealing with the financial instrument. Now we must know that what is the important, why it is important for us to know about this financial instrument. Now let's see in details. Now, when we invest in the stock market, it involves the exchange of different financial instruments. Price fluctuate a lot here. Some people gain during the day and others make a loss. Understanding the financial instruments are of importance no matter what type of trader you were. Successful trading is selling something for more money than it's purchasing it. The simple thing. This is why we need to know about the financial instruments. Now next come to the next part. Here we will see that where the financial instruments fall in the Indian financial system. Let's see in details. Financial instruments can be seen as something that shows whether the country's financial system is mature. If a country has different types of financial instruments, then it means that country can innovate when it comes to providing its citizens with financial products. To understand financial instruments better, we need to first understand where it falls in our financial system. These four major branches are, now we will see the four major branches. Regulator, Ministry of Finance, Reserve Bank, SEBI, IRDA. Next, financial intermediaries, bank, NBFC, financial markets, money market or capital market. Now the last one is the financial assets or instruments. Now this is all about the financial instruments fall in the Indian financial system. Now next come to the next part. Now in this part we will see the use of financial system. We are reading about the financial system. Till now we learned what is financial system. We also learned the importance why we have to the know about the financial system. Now we will see the use of the financial system. Now let's see in the details. Financial systems are created, traded, modified, or settled. They give traders the ability to transfer all the capital throughout the world quickly. They can be real or virtual. Documents, they, they actually can be real or virtual documents representing to a monetary contract. Now, financial instruments might or might not be traded in the stock market. Checks are also financial instruments, but they are not traded in the stock market. Some financial instruments are traded on the stock market and shares, derivation, or mutual funds. Now, this is the use of financial instruments. Now, let's come to the next part. Now we will see the layers of financial instruments. Now we will see the layers financial instruments through this onion. We will see the layers in each details. Now first of all we will see the layer 1, outermost part, is the contract. The financial instrument is a contract. As it is a contract, it is a legal agreement. So it will be a legal agreement that is binding on both the parties. Now next come to the layer 2, intermediate. It is the intermediate part, cash instrument or derivatives instruments. So the main types of, in layer 2, the main types of financial instruments are cash instruments or derivative instruments, as we already seen in this picture. Here one is directly valued by the market and later indirectly valued. Later is indirectly valued. So next come to the layer 3. Layer 3 is the center part, equity based or debt based. They can be classified based on their asset type, that is equity based or debt based. Asset class in finance means when financial instruments have a similar feature, then they are grouped together. Other asset classes are foreign exchange or commodities. This is about layer 3. Now next come to the next part. If an asset or instrument does not have legal agreement or a contractual claim, they are not financial instrument. Some non-financial asset or instruments are lands, buildings, patents, intellectual property rights. So in this slide we see the layers of the financial instruments. Now next come to the next part. Next we will see the types of main types of financial instruments. So we will see the main types of financial instruments are cash instrument, debt instrument, foreign exchange, and commodities. Now let's see the types, subdivisions in the types of financial instruments. Now let's come to the cash instruments. Under cash instruments we can see that securities, deposits, loans, bonds are the types of cash instruments. Now let's come to the derivative instruments. Under derivative instruments, forward, future, and options, interest rate swap. It is the types of derivative instruments. Now let's come to the foreign exchange. Under foreign exchange we don't have any types. Now let's come to the commodities. Under commodities we have sub-commodities like agriculture, and we also have hard commodities such as natural resources that we get from the nature. Now let's see the details of each type. First we will start with the cash type, cash instruments. Now we will see the cash instrument in details. In the cash instrument scenario, the buyer and seller are trying to work out how much each item worth or cash is worth. The different types of cash instruments are scenario deposits on loans. Cash instruments are securities that are readily transferable and are valued by the market directly. Now we will see the types of cash instruments. Now we will see the securities. Securities are the traded in the stock market, and if they are purchased or sold, they give you a small share of ownership in the company listed on the stock market. Now security have a monetary value. Now let's come to the next type of cash instruments, deposits and loans. If in case of deposits and loans, if both the lender and the borrower agree on the trade by deciding the times and the important exchange details, then deposits and loans are considered as cash instruments. They represent monetary value and are legally binding contracts. So this is about the deposits and loans. Now let's come to the bonds. It's bonds are the most simple thing. Bonds actually provide us a fixed income to the investors depending on their maturity dates. So this is all about the cash instruments and the types of cash instruments. So let's come to the next part, derivative instruments. So we will see what are derivative instruments. So let's start with the topic. Derivatives are financial contracts that solve the primary purpose of hedging asset price fluctuations. There are various types of derivatives. This includes exchange traded funds over the counter called OTC, forward, future options, interest swaps. We already seen these are the types of derivative instruments. A derivative instrument is where the price is indirectly determined by another asset or variable and not by the derivative contract itself. This is about the derivative instruments. Now we'll see an example of derivative instrument to understand it clearly. Let's say that you and your family, you and your friends are standing near a food seller shop and watching a customer enter and buy few things. Now you and your friends place a bet on the price of the item that the customer has purchased. This agreement between you two would be derivative, as the underlying asset would be the dry fruits which neither you nor to your friends own. Also, in this case, you can influence on the price that the seller or the customer decides. Now, this is all about the derivative instruments. Now, we will see the types of derivative instruments. First, we will see the forward. A forward is a contract between two parties that involves customizable derivatives in which the exchange occurs at the end of the contract at a specific price. Now this is all about the forward. Now next come to the future and options. Future and options are considered derivative instruments as they depend on the future performance of the stock price. It is predetermined contractual agreement as the transaction takes place in the future at a particular time. So this is about the future and the options. Interest rate swap. An interest rate swap is a derivative agreement between two parties that involves the swapping of the interest rate, where each party agrees to pay the other interest rates on their loan in different currency. So this is all about the interest rate swap. Now next come to the foreign exchange. Now in foreign exchange is a simple thing. Foreign exchange instruments are the financial instruments that represent in the foreign market. So this is the simple thing, and foreign exchange is the most simple thing. So let's come to the next part, commodities. Now we will see the commodities in details. Mutual funds are popular in India because the investment required for it is less and risk is low. The commodities are divided into two parts: soft commodities and hard commodities. We already know that. Now, in soft commodities, we have an example such as agriculture or livestock goods, and in case of hard commodities, we can have an example like natural resources, which are extracted such as oil, gold, etc. Now, this is all about the commodities. Now let's come to the next part. In this part, we will see the financial instrument class type. Now we will see this in details. Now, first of all, in this case, we will see the equity based. In equity based, equity is a type of security where ownership in the company can be represented, where you can trade equities in a stock market, which means that you can buy and sell them in the stock market. They have a good amount of returns on the investment, but there is also a risk. If you don't know much about equities, it is better not to invest in them without adequate knowledge. Now, the equity based financial instruments show ownership of an asset. Major share trading platforms in India are Bombay Stock Exchange (BSE) and National Stock Exchange (NSE). We have already seen these examples. Now, equity-based financial instruments are depository receipt, common stock, convertible debentures, and preferred stock. Now, this is about the equity-based. Now, let's come to the debt-based. Debt-based financial instrument actually tells about the loan made by the investors or to the owner of the asset. In India, public provident funds, debt mutual funds are the example of the debt-based financial instrument. Now, this is about the asset class types of the financial instrument. Now, let's come to the next part. Now we will see an example of the financial instrument. Now, let us assume that AB is a banking company giving a financial instrument, namely loans, to its client. Now, client is receiving this instrument in a liability that needs to be paid back, but it is a financial asset for the bank. Now, similarly, whatever the customer deposits in the bank is a liability to the bank and an asset to the customer. Now, this is an example. It's an example of the financial instrument. Now, let's come to the next part. Now, we will see the purpose of the financial instrument. What is the purpose of it? Now, we will see the purposes, and it is all about the purposes. Now, let's see the purposes. First of all, in the case of the first purpose of the financial instrument is the for hedging. Now, in this case, we can minimize the risk involved in the stock market through financial instrument, which include protection against price fluctuation through the purchase of option contract or buying and selling currency at a fixed future date through a future contracts. Now, next come to the trading purpose. This is all about the trading purpose. Knowledge of financial instrument can be useful to investors who want to benefit from short-term market movements by allowing them to take risk positions. this is about the trading purpose. Now let's come to the investment purpose. Investors with long-term goals such as receiving good returns from their investments will benefit from knowing which financial instruments to use. Now this is about the investment purpose. Now let's come to the end. In the financial instruments are the main pillars of all market operations. Whether it is associated with short-term or long-term investment doesn't matter. The financial instruments create the core strength of the country's economy. So this is all about the topic. Now, if you like our article, then you can share it through Facebook, Instagram, and Twitter. For any suggestions or views, you can comment on us. Till then, keep reading and growing our article. And thank you for listening. And thank you so much. Hope it will be helpful for you. Thank you.